Good morning, everyone, and thank you for joining us on Mphasis Q2 FY19 results conference call. We have with us today Mr. Nitin Rakesh, the CEO, and Mr. V. Suryanarayanan, the CFO. Before we begin, I would like to state that some of the statements in today's discussion may be forward-looking in nature and may involve certain risks and uncertainties. A detailed statement in this regard is available in the Q2 FY19 results announcement release that has been sent to you earlier. I now invite Mr. Nitin Rakesh to begin the proceedings of the call.
Thank you, Warren. Good morning, everyone, and thanks for joining the call. I hope you had an opportunity to go through our Q2 FY19 results and other operational performance information in our MD&A. We began the year FY19 with a strategic focus on growth along four key vectors, i.e. consistent, competitive, profitable, and responsible growth. We are happy with our execution on this strategy this quarter as we continue to grow our revenue and build a strong pipeline. Our renewed sales and marketing efforts and solution-led sales approach is showing good traction and helping us win in the marketplace. We are very pleased to report our highest ever quarterly new deal wins at $210 million of TCV in the direct international business, which is broad-based across portfolios as well as across strategic accounts and new clients. More importantly, around 77% of these deals are of new gen services, which is our focus area. We have seen an increase in the average size of the deals, and as well as the fact that we launched the One Mphasis approach is actually aiding our sales, and account mining is starting to show positive results in our other key portfolios. Our decade-long experience of working with DXC and the strategic client engagement framework that we launched last year has helped us build a strong partnership. We continue to build on this and had another quarter of solid revenue growth in Q2 19. Digital risk business witnessed some volatility this quarter due to cyclical headwinds, as we called out in our last earnings call. Despite these headwinds, we continue to operate in our stated revenue band of 28 to 30 million per quarter. Moving on to financial results of Q2 FY19. Consolidated gross revenue grew 6.9% QOQ and 24.5% YOY on a reported basis. The growth was 3% QOQ and 14.8% YOY in constant currency terms. The growth was driven by Direct Core and DXC businesses. Direct International grew 4.7% QOQ and 20.4% YOY on a reported basis and 0.7% QOQ and 10.3% YOY in constant currency. Direct Core, which contributed 81% of Direct International revenue in Q1, grew 8% QOQ and 24.6% YOY on a reported basis, and 3.9% QOQ and 14.3% YOY in constant currency terms. Direct Core business continues to witness strong growth momentum, which is broad-based across strategic accounts, Blackstone companies, and new accounts. Despite the volatility in the digital risk business, our key verticals with BCM, which is banking and capital markets, and insurance had both healthy growth. BCM grew 4.6% sequentially and 18% year over year, and insurance grew 7.2% sequentially and almost 9% year over year on a reported basis. With strong growth in emerging industry segment, which comprises of transportation, logistics, and healthcare at 12.1% sequentially and 31% year over year on a reported basis, we are pleased with our broad-based and diversified growth across verticals. DXC business grew 10.5% sequentially and 34.7% year over year on a reported basis and 6.4% sequentially and 24.7% in constant currency terms on a YOY basis. We continue to invest in this strategic partnership and are focused on further bringing new gen services to the core. Moving on to the margins, the operating margins improved 200 basis points year over year at 16.4%, primarily led by execution and operational efficiencies. As explained in our previous call, given our fully hedged position on a rolling 4-quarter basis, for FY19, the benefits of rupee depreciation are not reflected in the current margins, and we do not expect any material impact to FY19 profitability on account of any further movement in exchange rates. Operating margin declined 20 bips QOQ, primarily linked to initial transition phase expenses of certain large deals won during the quarter. The improvement in some of the key operating levers over the previous quarters have helped us improve margins YOY, thereby creating headroom to reinvest in growth and making additional investments to build key competencies such as Talent Next, as well as Next Labs. We are confident of operating within the guided band of 15 to 17% EBIT for FY19 after absorbing our upcoming wage increments that will be effective Q3 FY19. Our cash generation remains strong, and total cash on the balance sheet as of 30th September stood at rupees 25,185 million, which translates to about $346 million. During the quarter, we paid out rupees 4,662 million, including taxes as dividends, and adjusted for this outflow, cash and cash equivalents increased by rupees 2,476 million, approximately $35 million during the quarter. Overall, we are pleased with the execution so far on our strategic priorities of growth this year, with strong TCV wins and growth across major business segments. While normal seasonal quarterly factors will be in play, we are pleased with the health of our pipeline, the relative positioning of our service offerings and capabilities, and continued strong execution across multiple vectors, especially in new gen services. On that note, I thank you once again for your interest and will request the operator to open the line for questions.
Thank you, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star and 1. The first question is from the line of Nitin Padmanabhan from Investec Capital. Please go ahead.
Hey, hi, Nitin. Deal wins are pretty solid, but in that context, wanted to get your thoughts on the supply side of things. We see that a lot of growth is on site. So in that context, how should we think about the supply side? Is it really tight? And in the context of the wage increases, although we don't report attrition numbers, how do you see that sort of panning out? Do you think wage increases will be higher than historics, and what could be the impact there? And the second part was your thoughts on the underlying demand environment. The current quarter has been very solid, of course. But going forward, how do you see that? And, yeah, those are the two broad questions, and then I'll fall back into it.
Sure. So, Nitin, thanks for the two questions. I think, firstly, the supply side is obviously, the reason why we exist in business. So I think it's our core competence has to be to find the right people in the right geographies to support the right type of projects. So I necessarily wouldn't call out that as a constraint, and I know some of our industry peers have called that out as a constraint. But I think from our perspective, we have a supply chain model that is working well. We are agnostic to where the demand is in terms of locations, and of course, we have the ability to, convert and transform projects as they mature. But I think given that a lot of the growth and the demand happens to be in new gen skills, I think that the clients are fairly clear that a lot of this has to be co-located, and I think that's not necessarily a bad thing, because it also gives us the ability to actually have the right pricing strategy. On the specific question on the H or the visa, I think it's been a long-standing issue that we've had to deal with in terms of making our supply chain agnostic to the issues, and I think that from that perspective, we are fairly comfortably placed as well. The wage question that you asked us, I don't think there's anything to call out from an unusual perspective, because I think we will be in the normal stated bands that you'd expect, no different from usual years. Of course, there are pressures on the supply, but I think as I mentioned, I think it's the better way to do it is to actually continue to find growth for almost all of our employees by running them through better value-added work, and that actually is really helping us in retaining that talent as well.
Sure. And the last one was on the demand and your thoughts on the pipeline there. Do you see that sort of continuing in the context of all the worries around trade wars and all that's out there?
Yeah, I think also to give you some, if you look at, just to kind of go back to the on-site offshore thing, if you look at net headcount addition was actually higher offshore in Q2 than it was onshore. So just keep that in perspective. Revenue is probably a little more skewed towards onshore because of the realization and the rates, but I think good news is that we did add more headcount offshore on a net new basis. In terms of your demand question, so far I think at least in the near term, we don't see any major impact on demand. I think there are some macro headwinds that we are watching out, specifically, relating to the interest rate scenario and how that is impacting segments like mortgage, but not necessarily translating into any immediate, negative impact on the pipeline of the demand. But as I said, I think for us to be vigilant and prepared for any eventuality, I think we are watching some of those.
Sure, great. Thanks a ton and all the best. I'll fall back in queue. Thank you.
Thank you very much. Next question is from the line of Gaurav Rateria from Morgan Stanley. Please go ahead.
Hey, Nitin, congrats on good execution. Wanted to understand, you talked about the average deal sizes moving up. If you could highlight what's the sweet spot for Mphasis? Has that changed in the last couple of quarters? And do you think that you are now well positioned to even participate for deals which could be as big as 50 million or 100 million kind of deals?
So, Gaurav, I think nothing much has changed in the last couple of quarters, except that we are now, fairly focused and amplifying our message to the market in terms of our positioning and our capabilities. But certainly, we've obviously moved the needle in terms of the segments we want to play in over the last, I would say, 6 to 8 quarters. Our two primary motions continue to be service transformation-led, as well as the whole front-to-back transformation-led. So I think of these two as the primary motions. We are starting to see deal sizes go up primarily on two vectors. One, I think we have a pretty good way of early engagement with clients in defining digital projects, as well as helping them execute on deployment of new tech. And I think that machinery then continues to ramp up into next phases of the same program. So I think while common myth is that digital projects are small projects, I think the way to think about it is that digital programs are not small programs, and that evolution of working with clients in this co-creation, co-innovation model is paying rich dividends in terms of just continuing to increase the deal sizes. Secondly, I think the service transformation platform that we talked about over the last few quarters, I think we showcased some of that at the Analyst Day as well back in May. It's actually become a fairly strong differentiator in terms of deploying transformation to run IT or to legacy IT. Whether it happens to be in areas like support and maintenance, QA, application transformation, migration, and increasingly more and more conversations around legacy modernization through the next step or the service transformation platform. So I think those two, I would say, are the primary motions that are driving a lot of the deal discussions. I think the deal sizes you mentioned are not unusual for us. Of course, our intention is to continue to get a seat at the table as we get more aspirational about the larger deals as well. But as we get through that and we have more wins, hopefully you'll start seeing some of that reflected in the numbers as well.
Sure, thanks. Second question on the margins and digital risk specifically. While the revenues came off, has there been any impact on that part of the business on the margin front, and has that impacted your overall margins? And do you think that's a lever available for us if the growth comes back? Thank you.
I think, Gaurav, absolutely. If you remember the same call back after Q1, we did say that the DR business was still a little headwinded because the origination volumes are still declining, and I think that scenario hasn't really changed. So while we are maintaining our guided revenue band, that continues to be something that we have to continue to work through and around. Some of that does have an impact on margin, but I think the bigger impact on margin really came from the fact that as we continue to convert deals through the quarter, our ability to staff and and execute on those deals required us to actually invest a little more aggressively in our supply chain. So I think that was really what drove the margin this quarter. And again, keep in mind, we did guide the same band of 15 to 17 EBIT for FY19 in the last call. Despite being on the upper end of the band, we maintained that band because we saw some of this playing out last quarter. And we are still maintaining that band despite the MSI impact or the wage increment impact that we will have over the next 2 quarters, because we believe we'll be able to fund some of that through our operational efficiencies and revenue growth.
Thank you.
Thank you very much. Next question is from the line of Rishi Jhunjhunwala from IIFL. Please go ahead.
Yeah, thanks. Nitin, a couple of questions. One on digital risk. So remember we had talked about, a deal win from Citi, on digital risk. Any progress on that? And can we see this 28 to 30 million per quarter run rate going up over the next 4 quarters or so?
So, Rishi, I think while it's not appropriate to discuss any specific client projects or engagements, I think we continue to make progress on the transformational work that we started with the particular engagement we talked about. The entire effort and the reason why we've maintained our revenue band is because despite the fall in origination volumes, we entered into some near-neighbor areas. That has definitely helped us in plugging some of the holes that came from decline of volumes. We've also, been able to consolidate our position and get a higher share of wallet from some of the clients, probably at the cost of some of our competitors in some cases. And thirdly, I think we also started to focus on, areas where we think that we have the skill set, but we were necessarily not playing a bigger role because that required a slightly different sales motion. And fourthly, I think the ability to take Mphasis services to these clients has also improved dramatically in the last 6 months. So I think net, we are still growth-oriented in the business. Net new growth is probably a function of a little more stability in the core. But at this point in time, while this is a business is headwinded, we've worked around it in terms of making sure that it doesn't impact our overall revenue growth, to a large extent.
Does this business provide any kind of cross-selling or synergy to our rest of the business, or does it pretty much run on isolation?
No, that was the point I was making, that our ability to take Mphasis services to these clients has improved dramatically, because the whole point of launching the One Mphasis model was to be able to actually cross-sell these services to the financial institutions that we service in this business. The client base is obviously of very high interest to us, because these are mostly Tier 1 U.S. banks and financial institutions that play in the mortgage space. So I think that's one of the theses that we are really playing out right now.
And the decline in help desk and knowledge processes revenue on the horizontal vertical, both of them relate to this only, or is there any other component?
Some of it is here, but I think more on the help desk and service desk work. I think we did talk about the fact that we'll continue to apply transformation to bundle those into much more platform-driven businesses, and that has some impact on revenue, but that's the kind of transformation we're driving.
Okay, and lastly, can you give some color in terms of, the HP business that continues to grow pretty strongly? I think, you've been fairly conservative in terms of, suggesting where the growth rate could be on HP, but it continues to grow at a pretty healthy rate, QOQ and YOY. Some color on that will be helpful, because at least, we get, some sense on the direct from the deal wins, but not much on HP otherwise.
Yeah, I think it's a little tricky to kind of give you either deal wins or revenue guidance specifically, because I think it's a fairly concentrated book of business with 4 underlying clients. So from that perspective, I think our guidance almost always is based on, the fact that if we can grow this at or above market, then the rest of the company can easily be, grown above market, given the direct core is growing comfortably above market. So I think we are fairly pleased by the fact that we've continued to demonstrate 6 quarters of growth now in this business. This was a very headwinded business through FY16 and part of 17. So, while we are not apologetic about the growth, we are also fairly focused on making sure that we continue to provide value. So I think from that perspective, this is obviously a slightly, special segment of business, given that it's a partnership-led, book of business. So think of this at least for the remainder of this year to come to, at least have the clip rate that you see, and that itself translates into a healthy double-digit growth, which is clearly one of our fastest-growing segments, and that does move the needle.
Great, thank you.
Thank you very much. Next question is from the line of Sandeep Shah from CGS-CIMB. Please go ahead.
Yeah, thanks for the opportunity. Nitin, just a question on the direct core international business. The way I look at this business is more comparable to your peers as a whole. However, some of your peers in this industry are growing at a mid-teen or higher than the mid-teen. And for you to grow at a mid-teen for a direct core international, you may require an ask rate of 5 to 5.5% in the second half on a Q-on-Q basis. So is it possible? Because for the last 2 to 3 years, this segment of the business has been growing at a rate of 8 to 13%. But looking at the deal wins, do you believe that we can also inch up to the other mid-cap peers who are growing at mid-teen or higher than the mid-teen in this segment of the business?
So let me just point out two things. Firstly, I think let's differentiate direct core away from direct international, because direct core is really the most comparable part of our business as it relates to third-party IT services. That business has consistently grown in, I would say, the 13 to 15% range on a year-over-year constant currency basis. Even in Q2, it's actually 14.3% YOY CC growth and almost 4% QOQ growth. So I think if the question is, can we sustain the mid-teens growth for direct core, answer is yes, because that is definitely our crown jewel in terms of giving us the ability to demonstrate the fact that we can actually win against some of the largest competitors that exist at our client bases. I mean, this is most competitive red ocean, type business, and I think if we are growing at 50 to 70% above market there, which is market being defined by the 79% growth guidance for the industry, then I think we're very pleased with it, and we'll take it with both hands. Of course, the deal wins that we have will continue to drive that kind of growth. We are also driving transformation in that business, as I talked about, by applying levers of automation. So the fact that we've now hit mid-40s in terms of new gen, percentage of share from new gen revenue, it's 46% for, in Q2 of the overall direct core business. I think that's great news as well, because that business is actually growing, very, very, fast at almost 40+% rate for us. So I think given that we are growing new gen really rapidly, we are signing new deals, which are primarily new gen, and we are able to transform legacy IT into new gen, it gives us the fact that the long-term sustainable basis, this business will continue to grow.
Okay. The second question is in terms of margin, what we have said. I've just missed that initial remarks on the margin. So what are we saying? We are keeping the band of 15-18 with the wage inflation.
15 to 17 EBIT margin band is being maintained. We started Q1 strong because, we were at the upper end of the band at 16.5 plus. We've maintained despite being on the upper end at 16.6 actually in Q1, we maintained the band of 15 to 17 because we realized we'll have to make some investment as we ramp up for new deal wins. We do know that we have some, increment-related impact in Q3 and Q4, but we're confident we'll be able to fund that through our efficiency efforts, and some of that we fund it through growth. So net, we are maintaining our guidance range for EBIT at the 15 to 17 band. And the other thing I talked about the margin, which I think I want to repeat, because I want to make sure that everyone does understand that very clearly, is that there is no impact of currency depreciation on our margins in FY19 because we run a 4-quarter rolling fully hedged book. And for this year, that hedge is at 67.5. So whatever we actually lose in the hedge loss, we gain in the translation side. So net impact to EBIT is actually negligible. So from that basis, please don't assume that there's going to be currency depreciation-related impact that will positively impact us in FY19. As you look at the MD&A, you'll actually get the overall average hedge positions. Those are obviously over the next rolling 4 to 6 quarters. And hence, I think you should be able to get some idea of how that hedge rate will ramp up based on just the forward rate that you can see over the next 6 quarters.
Okay. Yeah, that's my second question was looking at your hedge tenure and the hedge rates. Is it fair to say that starting 1Q of next year, there would be a benefit or maybe a loss coming down materially if rupee remains in a band of 72, 73 rupees?
On a relative basis, yes. Compared to FY19, absolutely yes.
Okay. And just last bookkeeping question, on the G&A side, there is an absolute decline and there is a 60 basis point saving. So is it a new normal or there is some one-time savings in this quarter?
Yes, I think it's more one-time. This is Surya here. So it's more one-time savings. And if you see manpower cost, there's not much of a change. It's more professional charges and other, related charges, which is slightly lower this quarter.
Okay. Thanks and all the best.
Thank you. Next question is from the line of Ashish Chopra from Motilal Oswal Securities. Please go ahead.
Yeah, hi. Thanks for the opportunity. Nitin, I just had one question on the seasonality bit. So we've seen that the seasonality in the HPDXC channel has tended to be more pronounced than in the other segments. So just wanted to know, with respect to the visibility that you have on the business, you think that, that we'll be able to shun it? And also, how would you compare it in the direct business in the second half of the fiscal?
So, Ashish, I think the underlying nature of the seasonality is the same across channels. So I think, at least at this point in time, there's nothing to call out, specifically between direct core or HPDXC. Again, I think it's still a little early days. We'll see some of that impact. Some of the impact's already known because of just the number of billing hours or billing days this quarter. But some of the other impact is almost always client-specific, very, very focused discussion that happens at multiple levels. But I think at this point in time, there's nothing to call out in terms of the two channels specifically.
Fair enough. And just secondly, maybe Surya can help me with this as well. So in 3Q FY18, we changed the hedging policy to extend the maturity of hedges to up to 2 years. So could you help us know what percentage of the exposures from quarter 5 to quarter 8 would also be hedged for now?
Yeah, so it is in the range between 50 to 30%, 50, 40, 30.
It's like a staggered hedge.
Staggered hedge for the second year.
Okay, got it. That's it from my side. Thanks and all the best.
Thanks, Ashish.
Thank you. Participants who wish to ask a question may enter star and 1 at this time. Next question is from the line of Ruchi Burde from Bank of Baroda. Please go ahead.
Hi, could you update us our progress on initiative on Europe business?
Sure. I think we are pleased. Europe is growing fairly well. Last 2 quarters, it grew much faster than the company. I think in Q2 is probably in line with the company growth. It's still a strategic area of focus for us. Pipeline continues to be strong. We actually have started to see benefits coming out of investments outside of the UK, both in France as well as on the continent. So I think continues to be work in progress, continues to be a good growth market. And we see the opportunity to be a fairly good size opportunity there. So I think it's still going to be an investment area for us, and hopefully we'll continue to grow that at least at or above our company growth rate.
That's helpful. Secondly, we understand that you'd mentioned you won't call out a number for Blackstone deal on quarterly basis, but qualitatively, could you talk about how the health of pipeline in that business at this point of time?
I think it's fairly strong because not only did we create a good, strong, foothold last year, I think a lot of those relationships are also continuing to give us good growth. as well as referenceability. But given that, I think there is no, this is always a lumpy, deal by deal business. But overall, I think the number is, we're pretty happy with not only the pipeline, but also the conversions that we've done on a quarterly basis.
That's helpful. That's it from my side.
Thank you.
Thank you. Next question is from the line of Ravi Menon from Elara Securities. Please go ahead.
Hi, thank you for the opportunity. Just wanted to understand, what if you could give us some color on the emerging industries growth. That's contributed to, I think, roughly about half of the revenue addition this quarter. This is all primarily from Blackstone portfolio companies, or is there something more to it?
No, I think, Ravi, there's no correlation between Blackstone and emerging. The emerging industries, as I called out in my remarks, is transportation, logistics, and healthcare. And I think these are what we call the Horizon 2 markets for us that we started to invest in for the growth. Again, off of a small base, the growth is pretty good. Given that some of our large client relationships are now sitting in this segment, I think we are also fairly happy with the fact that we have reference clients outside of BFSI. And as I said, we'll strategically, invest in some of these at a sub-vertical level. So some Blackstone business may sit there, but I don't think there is a direct correlation between emerging and Blackstone.
Right, thanks. So can we say that this should be one of the main growth drivers for the company even going forward?
I think, Ravi, again, if you look at the reason I broke out, and it's in the MD&A as well, the reason I actually mentioned that in my remarks is I think there were some questions about insurance growth last quarter. There was also some question about whether banking is growing or no. I think from that perspective, we are very happy that almost all of our industry segments have grown. Of course, banking being the largest, has a base effect to it, but given that all four of them are actually growing well, I think our overall hypothesis is that we should continue to see broad-based growth. By sheer nature of size and numbers, the growth may look skewed towards one segment versus the other.
All right, great. Thank you. Best of luck.
Thanks.
Thank you. Next question is from the line of Rahul Jain from Emkay Global. Please go ahead.
Yeah, congrats on good number. Firstly, on the TCV basis, how one has to read this, because if we look at from a trailing basis, the data for the 4th quarter looks like a 20% growth. So if one has to relate it with the past order book, how one can put analogy? Is it the tenure that is different, or any construct that you could give there?
Sure, Rahul. I think two factors to think about when you start to model the TCV win into revenue. Firstly, given that we are applying service transformation construct, some of these deals have started to be longer tenure, which is great because it gives us the stability and the annuity of the revenue. So it's not unusual for us to see deals between 3 and 5 years, especially as we apply transformation to those deals. And I think that gives us, as I said, ability to apply transformation and optimize those operations. Second, also, I think we've talked about the fact that our new gen services have grown very fast, and the fact that we have to continue to transform some of our traditional services. That does have a dilutive impact on the overall revenue growth, because if you had an engagement that was primarily T&M or managed T&M and you're going to convert it into managed services by applying transformation, some of that will have an impact on the revenue run rate. But if you can bundle that into a longer-term contract, then you actually get much more stability, and that's the strategy we've been following, which is why you've seen that our overall fixed price percentage has also gone up pretty nicely over the last 4 quarters.
Okay, and from the HP perspective, it is adding more disproportionate share to the incremental revenue, and we don't have much view in terms of the kind of growth one can anticipate. Is there anything that we could look at that could help us? Because if you look at historical data, it used to be much larger engagement. I don't think if it is the right comparison to even look at that number for us in the future sometime, or is that something can still happen, or any other way you could give some input on this.
Yeah, I think again, as I said earlier, it's given that there are 4 underlying relationships, I don't think it's comparable to the olden days that you're referencing to. Obviously, the trajectory of each of those 4 relationships is different. But given that we are already at a 300 million plus annual run rate in the business just based on Q2 number, I think the trajectory will obviously be driven by how much more pipeline we can keep driving. And conversions are fairly immaterial because, as I said, the paradigm is slightly different. So even if we stay flat for the remainder of the year, we'll on a sequential basis, which is, I'm not saying we will, but I said even if you take the Q2 run rate, we are looking at a high teen growth in the business. I think at this, for this year at least, that's a good thumb rule to follow. As we get into FY20, we'll give you a little more color maybe over the next couple of quarters. But I think right now, if you look at the high teen kind of run, growth environment for the business for this year, that will be a good thumb rule to follow.
Okay. And lastly, on this others revenue, what is the mix right now, and what we think is the right way to look into this number, because this trend has been always a bit tricky.
Yeah, I think broadly, as I said, that's a business that has its own shelf life. It's mostly the legacy old business, primarily focused on the local domestic market, that we're not strategically investing or growing outside of our direct core customers. So, I mean, there are certain segments that we are investing in, but that is our global client segment. So think of this really as a line that will at best stay flat, at least for the foreseeable future. And of course, as things change, we'll update you as well.
Okay, so from an annual perspective, one should look it as a stable number.
Yes.
Okay, thank you. That's it from my side.
Thank you. Next question is from the line of Viju George from JP Morgan. Please go ahead.
Yeah, hi. I'm just trying to make sure that I understand this well in case this has not been discussed. Did we see a very significant decline in the DI business ex-DC?
Sorry, DI, you're talking about rest of direct business.
Correct,
so
correct.
Well, it depends on what you define as significant. Of course, the digital risk business has really contributed to some of the phenomena you're seeing in the direct international business. I think the band that we've talked about is 28 to 30. Last quarter, we went above that band given certain deals that we executed on, and this quarter we are probably at the lower end of the band, and that's what's driving that.
Okay. Because by my math, it appears that you're almost like close to mid-teen kind of a decline sequentially. I mean, so clearly above the 10%.
That may not be accurate. I think you should, based on the overall. I mean, in the end, it's broken out into the MD&A, but effectively that's what's happened really in the DR business.
Sure. Okay, thank you.
No problem.
Thank you. Next question is from the line of Ashwin Mehta from Nomura. Please go ahead.
Hi. Just one question in terms of margins. What is the impact that you see going into the next quarter because of wage hikes, and would it be a full impact next quarter, or there's some staggering involved there?
Ashwin, I think the best guidance I can give you is that we continue to operate in the 15 to 17 EBIT guideline. As I said, we created some headroom for ourselves in the first quarter because we knew we had to kind of reinvest some of that in Q2. And on that basis, I think it's fair to assume that we'll have to continue to find ways to operationally stay in that band despite the wage impact. So I think at this point in time, that's the best guideline I can give you. A lot of other moving parts to it, especially, as I mentioned, right, deal wins, conversions, and the seasonality of Q3.
Okay. And the second thing is just a follow-up in terms of the seasonality that you typically see in HPDXC. Last year, we did not see that kind of a pronounced seasonality in terms of the HPDXC business. Would you say, given the fact that some of the business is starting to be much more fixed bid compared to earlier, the possibility of sharply lower revenues is lesser?
I think, again, seasonality has an impact on existing run rate, not so much only on overall revenue, because it really depends on how much growth and how much deal wins you have in the quarter as well. So I think it's fair to assume that we're definitely not guiding towards decline in revenue. We are basically saying seasonality might have an impact on moderation of the jump.
Okay, fair enough. And just the last one, in terms of what would be the duration of the deal flow? Because you seem to indicate there seems to be some increase in terms of that duration. Earlier we'd highlighted it was more like 3 odd years. So has that materially changed in terms of what you signed this quarter?
I think, again, it's a mixed bag because, after $210 million, not every deal is a 3 or a 5 year deal, because there are deals that require us to deliver within 2 quarters. There are deals that go on for 6 quarters if there are development projects, or there are, these, what we call, agile Scrum team type engagements. If there is a run business, if we are bundling it into service transformation, then it's not unusual for it to be a 3-year deal, and in some cases even a 5-year deal. But it's really a mixed bag. I think it's good to assume the average duration to be in that 3-year band.
Okay, fair enough. Thanks a lot and all the best.
Thank you.
Thank you. Next question is from the line of Dipesh Mehta from SBI Cap Securities. Please go ahead.
Yeah, thanks for the opportunity. 2 questions. First is about the HPDXC. I think typically earlier we used to help desk, service desk used to get reflected in the traction which we used to see in HPDXC. This time seems to be different service lines. So can you help us understand nature of the business and how that is changing in HPDXC, and how one should look at the expansion in relationship, if you can provide some details there. And second is margin related. We have indicated some transition cost impact this quarter. Is it possible to quantify it, and whether it will continue in Q3 or this is now almost done kind of thing? Thank you.
I think on the first one, again, we signed the application transformation and cloud migration partnership last year, so that's starting to reflect in the growth in terms of the kind of businesses we are starting to impact. Of course, opportunity is much higher, and we've just started to see the impact of that. So one can assume that we'll continue to see more traction on that side compared to the traditional IMS or service desk type businesses. Even though when we get an opportunity to apply service transformation, we'll not be shy in taking that opportunity, as long as we know we can actually apply that transformation and make it work for both parties. On the margin side, I think some of it's already washed through, because as we continue to execute on the sold TCV, we'll start converting that to revenue. But some of it will, as I said, depend on how much deal wins we're able to generate in quarter. Given that we are running slightly high utilization levels, I think the margin for further tightening on utilization is limited. So we'll have to make certain dynamic calls, I would say, over the next month or 2, depending on how the wins are shaping up. So I think for now it's fair to assume that we'll be able to, as I said, maintain the EBIT band between 15 and 17 for the remainder of the year.
Sure. Just on the first part, we have seen some weakness in service desk kind of thing. So what would be the tenure of those such deals kind of thing? Just to get sense of decline happened this quarter, which seems to be decent decline.
I think every decline is, some of it is, as I said, strategic, because we are trying to bundle those into service transformation type deals, and some of it is, and as you do that, as I mentioned, there's an impact on the top line. And some of it also is that keep in mind, this is a percentage. And I think while on an overall basis the decline may not seem large, on a percentage of revenue basis it seems larger because the other businesses have grown much faster. So I think that phenomena is really what's causing you to see that shrinkage from 8% to 6%. But I think on an overall basis, we are happy with the quality of revenue we are generating, especially the fact that we've actually seen a nice bump in the applications business, this quarter. Between application maintenance and development, we've basically seen a 4 to 5% jump in the share of revenue on a sequential basis.
Sure. Thank you.
Thank you.
Thank you. Next question is from the line of Apurva Prasad from HDFC Securities. Please go ahead.
Thanks for taking my question and congrats for the numbers. Nitin, on the TCV, can you give maybe more highlights in terms of geographies or verticals? You talked about the duration, but anything on that side?
I think it's, Apurva, it's fair to assume that it's widespread across verticals. It is clearly, I wouldn't say there is any one vertical or one deal that is driving the wins. There are, and from a geography perspective also, I think keep in mind that 80% of our business is U.S., so that's clearly got the lion's share of our deal wins. Some of these wins, interestingly, this time are also global in nature because we're supporting clients globally as well. So I think I'm less fussed about the geographical distribution, but I think overall I'm pleased by the fact that this is actually fairly broad-based across verticals, and that's what you're starting to also see in the cross-vertical growth.
And fair to assume the direct core proportion within that similar to earlier levels?
That 81% of revenue is direct core, and that bulk of the wins are led by direct core. Of course, we have wins in other segments as well, but it's not dissimilar to the revenue proportion.
Apurva, just to clarify, as we have stated earlier, it does not include any deal wins from the DXC channel.
And also does not include any renewals. So these are net new TCV wins.
Right. And just to also confirm what you said earlier, you expect digital risk to continue in the 28 to 30 quarterly band going forward?
Right.
Okay. And lastly, on the fixed price trajectory, that declined this quarter, you were expecting that to inch up gradually. So, I mean, how should that shape?
Yeah, I think again, I would not take one data point. I think overall our approach and our approach and strategic mindset is still to continue to grow that, especially in the run business. So I think overall, again, if you look at it on a revenue basis, it's still grown. Of course, there are certain projects that will transition into fixed price as we actually continue to mature them. So there is an element of transformation that will get applied there as well.
Okay. Thanks and all the best.
Thanks.
Thank you very much. As there are no further questions, I now hand the conference over to the management for closing comments. Over to you.
Thank you, guys. Again, we appreciate you jumping on the call early in the morning, given that we were operating from the U.S. this quarter. We appreciate you taking the time day after the holiday, and we look forward to continuing to see you as we go through the remainder of the quarters this year. So thank you so much, and look forward to talking to you soon.